All right, good morning, everybody. Just continuing from where we left off. Last week, we started to talk about the concept of the cash flow statement and started to model the cash flow statement. And just to reiterate, without getting into too much repetitive detail, the cash flow is separated into three major segments: cash from operating activities, cash from investing activities, and cash from financing activities. And I think what's important to understand is the derivative of this. And when we say, let's take the first bucket, cash from operating activities, you could take that literally as the operating activities, which is your income statement. Your income reflects your operating activities. How much of that income statement actually reflects cash? And I would recommend to go back to the last class to really see the illustration of how that makes an impact, right? You can achieve, in this example, $2,100 in net income, but that does not necessarily mean you have $2,100 in your cash account. Why? Because in the income statement, you can book or record revenue, but maybe the customer didn't pay you yet. He was on credit. Or you can record expenses, but maybe you did not pay those expenses yet. You have a bill in the mail, you didn't write the check yet. So it hasn't left your bank account. So that's why we want to take a look at understanding how much of that $2,100 actually reflects the cash movements. And so when you take a look at stepping back all the components of an income statement and break out all the pieces that may or may not be cash related, you see that there could be a portion of revenue that might not be related to cash. And that's related, that's the revenue that you have not yet received in accounting is accounts receivable. The cost of goods sold that you have not yet paid is accounts payable. The expenses that you have not paid are accrued expenses. Depreciation, we'll talk about in the next class, is theoretical in the sense that you actually, even though it's an expense that's booked, it's a tax deduction, you actually do not write a check. It is always non-cash. So depreciation is something that's always added back. Some exceptions, some one-off exceptions, but generally speaking. Interest in this example, in most examples, again, some exceptions, but interest you typically always pay, right? If you're not making your interest payments, you're really defaulting on your debt, right? So you usually always make interest payments. Again, there are some exceptions. You can defer interest, but we're talking general here. Income tax, you can defer portions of your income tax. We're going to learn about that next class. So what I'm saying is, if you take all the segments of an income statement and break out all the pieces of non-payables or non-cash items, you have deferred taxes, depreciation, amortization, accrued expenses, accounts payable, accounts receivable. I'm being very brief here. You can come up with a multitude of line items, but I'm just summarizing. And we will soon learn accounts receivable, accounts payable, accrued expenses is also called working capital. And this is how the cash from operations formula is derived. Cash from operations is net income plus deferred taxes, depreciation and amortization, and changes in working capital. It is literally backing out the non-cash items from your income statement. That's what it is. So when you think about, well, how do I obtain a measure of cash flow? You take your net income and you back out the non-cash items. That's cash from operating activities. Then you want to think about, well, cash moves from two other categories: your investing activities. And investing activities can be summarized as the most common CapEx, capital expenditures. Again, this is the starting point for depreciation. Capital expenditures is the monies set aside for the future purchases or improvement of your property and equipment. That's an investment. Another common investing activity are purchases of businesses, sales of businesses, or purchases of subsidiaries of businesses, sales of subsidiaries of businesses, and investing in, funds and stocks. A lot of big companies or even small companies would set money aside. Instead of having it sit on the cash flow statement, they'd invest in funds and stocks and hopefully generate some income there. That's investing activities. And then you have financing activities, cash from financing activities. And the most common of financing activities are payments and receipts from your debt. If you have debt, you either receive monies from raising debt or you pay back the principal balance of those debts. Right. So the biggest line item, main line item in the financing activities is the issuances and paydowns of debts. It's a financing activity. Also, issuances or buybacks of stock is a financing activity. Paying out dividends is a financing activity. Those are the major financing activities. So those three categories together make up the cash flow statement. And we looked at Amazon's cash flow statement and started to lay out, as they have it, their cash flow statement. So unlike the income statement, where you have to kind of think like an analyst and say, all right, well, even though Amazon has laid out their statements in this way, we want to make EBITDA come through. We want to move things around for valuation purposes. Unlike the income statement, the cash flow statement, we pretty much want to lay out line by line as they have it. A couple of exceptions we're going to make, but we've pretty much done that all the way down through the cash from operating activities. And now we want to go down to the other two categories, cash from investing and cash from financing. So let me pull up the annual report and let's continue. And you'll see, let's go down to, you will see the first line item that you will note is purchases of property and equipment. That is capital expenditures. Capital expenditures is the purchase of property and equipment. You typically always see that as a larger line item in the investing activities section. We have that laid out in our model right here, on our template right here, CapEx. I put CapEx first, purchases of property, leasehold improvements and equipment. So we will literally 11,955 hard code these numbers in, 13,427 and 16,861. Next, they have proceeds from property and equipment sales. So selling equipment. We have this in our template, proceeds from sale of property. Common line item to have. 1897, okay, 2104, 4172. Okay. Then they have acquisitions of businesses, acquisitions net of cash acquired. So do we in our template. So they are following a standard format. 13972, okay, 2186, 2461. Okay. Then they have sales of maturities of securities. They are selling, investments, selling securities. Okay. So we have proceeds from sale of businesses. They don't have that line item. So I'm going to delete this line item. This was just taking our template and adjusting. So I'm going to delete this proceeds from sale of businesses. They don't have that there. And so to delete this line item, I'm going to hit Shift Spacebar, Alt ED. Now, the one thing we will do that that they didn't do is, and we'll see this again in the financing activities, they have separated proceeds, sales, the money coming in from selling securities, and the money spent from purchasing the securities. I'm going to combine those. In my line item, I have the investments and proceeds as one line item. It's going to help me make the projections and see. I don't necessarily want to know how much is being sold versus how much is being purchased. I want to see the net flow. between the two. If you want to get into the detail and keep it separate, it's not going to change the numbers there, but I like to see the net. Okay, so what I'm going to do is I'm going to take 9677. I'm going to go equals 9677 minus 12731. I want to see the net change. So in the end, after the purchasing and selling, they have a minus value of 3054. That's the way I like to look at the investing and even the debts we're going to see later. The smart, here we go, marketable securities in the next year is 8240. Oops, 8240 minus 7100. Okay. I'll put an equal sign in there to make that a formula. So here they're up a little bit. And then again, 22681 minus 31812. Okay, this looks like a larger loss. So now I can see a better trend, right? when I want to think about making projections here. So it's a little down, a little up, more down. I'll maybe kind of repeat that cycle there. Buying, selling, right? What else do they have? That's it. Those are their total investing activities. Okay, so I'll remove this other line item, and we're going to see if this matches. Make sure I hard coded everything appropriately. 27084, 12369, 24281. Yep, looks good. I'm going to put my line. When I deleted that row, I lost my line, my border. To create the border, I'm going to show you how to do this. Control 1 is your advanced formatting tab. I go to border. This is a box that represents a cell. Do you want a line above the box? Do you want a line to the left? Do you want a line to the right, in the middle, to the right? I want a line below. Whoops. I want a line below. Okay. Okay. And there it goes. Okay. So laid things out line by line. I did one consolidation there. Let's look at the financing activities. And here we go again in consolidating the proceeds and the repayments. Now, consolidating the proceeds and repayments of the marketable securities, that's really a personal preference. I actually might not even lay that out in the book. It just makes projection. It makes me, I like to see the net, right? That's just my in terms of projecting and things like that. Some people might argue with me and say, well, I want to see the gross. Fine. In the debt schedule, however, in the financing activities, however, when looking at the proceeds and repayments of one debt instrument, this is the proceeds of long-term debt and the repayments of long-term debt. We need to net that out because of the way it's going to link in from the debt schedule. We will see. We're going to link this in from one line in the debt schedule. So when you just kind of keep this in the back of your mind, that it is a necessity, the way we model, to link in the proceeds and repayments as one line item. So I'm going to go, here's short-term debt. Now, I'm going to keep this short-term debt line item in here, even though they have not explicitly stated and listed short-term debt, just because it's pretty unusual. Every company has short-term debt. I wonder if they lumped it in with their somewhere else. I'm going to keep short-term debt in there as 0, just because I think it's a necessity in every template and every model. Long-term debt borrowings, and again, in repayments, consolidated here, 16,228 minus 1301. 16,228 minus 1301. Okay. Next line, 768 minus 668. Interesting swings here. Must have been a big issuance here. We'll look into it. 2273 minus 2684. Okay. So we have, guys, I'm going to change my, hopefully you can hear me. I'm going to change my, I'm realizing I'm on a bad internet network. I'm going to swap it real quick. Hopefully you can, we're not going to lose you. Okay. So interesting what's going on here. Flow in, Must have been a big debt issuance here. Actually, I know I've done the research, but I'm just trying to talk through how I think about it as an analyst. Money, a little bit of money coming in here, and then they're paying down. Okay, what's next? They now have principal repayments of finance leases. So these are capital leases. Okay, so here we have some other line items that they don't seem to have here. Proceeds from issuing stock. They have been issuing stock. Proceeds from issuing preferred stock, then common stock, then buying back stock. I'm going to leave those in there as zero just for you guys. I mean, as a template, you really want to consider those line items. Those are pretty common, although Amazon's not doing it. Also, common dividends, right? Okay. They have principal repayments of finance leases. So I'm going to say principal repayments of finance leases. Also known as capital leases. They changed the terminology to be finance leases, capital leases, minus 4799. Okay. Minus 7499. And minus 9628. Now, what I'm going to do here is I'm going to actually move this line up to underneath the long-term borrowings, pretty much because this is the standard hierarchy of debts. You have short-term, long-term debts, then you have capital leases and any other lease obligations. That's all going to be reflected in our debt schedule. So I want that kind of, again, formatting preference in one bunch. I don't want to see debt, then equity, 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 debt. So I'm going to take this line, I'm going to move it up. So shift space bar, control X. I'm going to go up to the proceeds from issuance of preferred stock and insert this above. So control X, shift space bar, control shift plus. Okay, we'll do that again. So control space bar highlights the row, control X, go up to row 31, highlight the whole row, shift space bar, control shift plus, inserts the row. Okay. Now, I'm also going to create another row for this principal repayments of financing obligations. Okay, so I'm going to go right under row 32, shift space bar, control shift plus. What I'm going to do here is I'm going to copy this line down, because what that does is that gives me the formatting. If I start typing here, I'm going to have to reformat the line. So what I like to do is I like to copy this line down. So shift space bar, shift down, control D, and I'll just overwrite, because now I have the formatting in here. Otherwise, I'd have to reformat this whole row. This is principal repayments of financing obligations. Financing obligations. Okay. And we got minus 200, minus 337, okay, minus 27. Okay, now this is all zero. This was from the template 0, 0, 0. And what I'm going to do is I'm going to sum everything up. Up to you if you want to remove these zero line items. I'm going to keep them in for the template when you guys have it, so you guys have it. And a quick way, as you know, as we've learned in the first couple classes, to sum everything up in a column is Alt equals. Adds everything up. And let me make sure I included everything. 9928, 7686, 10066. Good. Now, they have, which is common in big companies that have a lot of subsidiaries in other countries, they have a line item called foreign currency effect on cash, cash equivalents, and restricted cash. What that means is every company subsidiary has their own cash flow statement, right? Then at the headquarters, Amazon's in Washington, New York, in the States, right? Then for the headquarter company consolidates. They add up all the subsidiary line items. Well, what happens is when you add up each subsidiary values in different currencies. So when you add everything up, there's going to be an adjustment that needs to be made based on the value of the currency exchange. That adjustment is made down here. So I'm going to add that line item above total change in cash, cash equivalents. So Shift space bar, Control Shift plus, and I'm going to call it, just as they have, foreign, can't spell, currency effect on cash equivalents, and restricted cash. Okay. Doesn't need to be bold. Control B. Foreign currency effect again. Okay. All right. And I hard code it. 713 minus 351. Whoops. Minus 351. And 70. Okay. And that's going to be hard coded. So unbold, blue. It's got to be a true blue. For whatever reason, it isn't. It doesn't save up here. So I know a true blue is 0 red, 0 green, and then 255 blue. Okay, guys, I did that very quickly. We did it before, but Control 1 gets back to our formatting. So sorry, I didn't do it that way. You could do it that way, but I went up here. I went more colors. I went to custom, and that's when you can select. If anybody knows how to permanently, I'd forgotten how to permanently get that blue up here. I don't know why the standard color isn't just a straight up blue. You have recent colors now, but that somehow from in my version of Excel goes away. There used to be a way to just drag this up, but I don't know. Maybe there's a setting I got to dig through. Okay, so for our total change in cash and cash equivalents, it is the sum of all three major categories: operating, financing, and investing, plus the effective currency. So I'm going to go equals cash from operating. Whoops. Sorry, cash from operating plus investing plus financing plus foreign currency. There we go. I want to make sure that matches. 1922, 10317, 4237. Excellent. We will deal with this when we get to the debt schedule. This is a line item necessary for our debt schedule. Okay. Now that we have our entire cash flow statement laid out, we need to project. To project the cash flow can get tricky because the cash flow statement can consist of a lot of little line items that are difficult to project. And we're going to go back and utilize the 7 methods as we discussed, okay? But one thing that is consistent, I want to walk through high level, a lot of the cash flow line items will come from other tabs. Net income comes from the income statement. Depreciation will come from the income statement, which will come from the depreciation schedule. So next class, we're going to start talking about depreciation. Okay. Deferred income taxes, I've highlighted yellow because that will also come from the depreciation schedule. Working capital line items will come from the working capital schedule. Okay. And in the financing activities, all of our line items related to debts, okay, will come from the debt schedule. And we'll talk about the debt schedule later. So what we want to do is now go in and think about how to project all these other little line items. And I'm going to give you my thought process. And this is the trickiest part. There's no right or wrong answer. It's all about making a model. It's all about, as an analyst, not getting too lost in one projection or another in the beginning. Get the model built out, highlight ones that you're uncertain of, get your valuation and say, well, what if I projected this a different way? Does it really impact my valuation? This amortization of intangible assets was just left over from our template. In fact, I'm going to delete it. Okay. Well, no, I deleted it. I messed up my whole model. Okay, let me not cause too much confusion. Keep it 0. Stock-based compensation. Okay. This was tricky. I want to walk you through my thought process. Now, remember the 7 methods of projections, right? the 7 possible ways. Whether you know or don't know what the derivative of the line item is, there are 7 common ways, technically, projections end up being calculated. 1, you take the average. 2, you could take the maximum. I'm going to be conservative and say, all right, well, let me assume this is the, well, here, the maximum is not conservative. The maximum is aggressive because this is cash coming in. So 3, you take the minimum and say, all right, well, I'll take the minimum of cash coming in. 4, you take the last year. Thought process being last year is the most indicative as opposed to going 3 years back for a trend, right? The minimum would be 3 years back. The last year is more indicative of what next year is going to be. 5, you take an average. 6, you repeat the cycle. Things that are cyclical. Sorry, repeat the cycle is 5. Repeat the cycle. Things that are cyclical. More common if you see negative, positive, negative, positive. 6, you would take a growth, percent growth. Revenue, we project percent growth. And 7, you would take a percentage of an operating item. So for example, in the income statement, all the expenses, we did percentage of revenue. So what I had done when I looked at those 7 methods, I had said, well, okay, well, I'm not going to do maximum. I'm not going to do max, right? Because the maximum is not conservative at all. I can look at the minimum, but I get concerned when the minimum is 3 years back and I see a trend. This is growing. So I don't think the number 3 years back is going to be indicative of what's going to be the next year. So I said, well, what about taking last year's? Well, last year's is the most aggressive. I said, all right, well, let me follow this trend. Let me calculate this growth, okay? And so I'm not going to spend too much time doing it. I want to show you what my thought process was, but this growth came out to be about 30%, pretty aggressive. So when I took growth and extrapolated it out, this was like $50 billion. I said, this is too crazy. No. I could have taken an average, but I do see a trend here. So I said, okay. And side note, when thinking about projections for operating activities, remember, this is cash being added back from an operating activity. So the derivative of this is operating. So when thinking about that, I said, okay, well, let me look at this as a percentage of an operating activity. And so I first took a percentage of where is it? I'm going to show you. Which one? I took a percentage of let me show you. I want to hang on. Oops. I want to show you. Okay. I want to show you exactly my thought process. So I took a percentage of, this is important. Sorry for the delay. What did I take a percentage of? Okay. Right. I took a percentage of selling general administrative. Okay. And it came out to be, sorry for the delay there. I wanted to be 100% sure. And it came out to be, well, the thought process being that stock-based compensation is paying employees, right? So you pay employees, it's a percentage of salaries, which is probably somewhere buried in selling general administrative. Numbers didn't look right. So in other words, when I say didn't look right, when you look at doing a percentage of an operating item, so for example, fulfillment as a percentage of revenue, This looks right, 14, 15, 14. It's consistent, 6, 6, dropping a little bit to 5, 6, 6, 7, which is a sign that this is probably a good way to make projections. When I took stock-based compensation as a percentage of SG&A, it was like 89%, 93%, 82%. It was all over the place and an unusually big number. Didn't make sense. So then I said, well, all right, let me look at a percentage of total operating expenses. Maybe that's a little bit more sound. And when I did, let's do it together. Shift space bar, it looked better. Okay, Control Shift plus. I'm going to go a percent of total operating expenses. Okay, italicize, Control I. I'm going to go equals 2017 divided by the 2017 total OpEx. Okay, now I got to format this. Percentage, want to go out of decimal, want to italicize. It's black because it's a formula, 8.4%. What is it over the next 2 years? A lot more consistent. Side note, very common metric instead of total OpEx is take a percentage of EBITDA. However, I tried that and the numbers were also crazy. 14, 9, 23, it wasn't consistent. So I'm going to stick with total OpEx. And for 2020, I'm going to take last year's 8.7, format this, italicize, and I'm going to back calculate. So I'm going to say equals 8.7 times my projected OpEx. Okay. And I'm going to go with these numbers for now. So copy right. It's growing. Make this black as the formula, but more adequate, makes a little bit more sense. We're going to go with this for now and see how the numbers fall. Okay. Other operating expense was also similarly as tricky. Okay. For other operating expense, I also didn't know how to think about it. So what I had done was I had looked at several of the 7 methods. I noticed a downward trend. Okay. I looked at this as a percentage of total OpEx, and I got a ridiculously low number. It didn't really make too much sense. It was bouncing around. I looked at it as a percentage of other operating expense income, which again, you might think it's probably related to in some way. Again, I got crazy percentages. Okay. So I also looked at the most conservative is the minimum, which is this number. The last year method is this number. I always like it when 2 or more of the 7 methods end up giving me the same number. So what I had done was I had taken the conservative approach and I took the minimum of all 3 years or the last year. And just so I can show my associate my thought process, I actually put the formula in, equals minimum 1, 2, 3. To me, that was the most conservative. And so you want to be careful. If you copy this to the right, all your references shift. Now this is going to show the minimum of those 3 and the minimum of those 3. So we will learn in the depreciation schedule to lock those references in. I'm going to put dollar signs, $D, $12, $E, $12, $F, dollar signs means now when I copy to the right, the reference to those formulas won't shift. So my associate knows, well, why did you take this number? Well, I'd say this is the most conservative. This is the least money coming in. I thought, this is the way what I would say, I thought logically this is probably based on the total operating expense here, but when I took a percentage, the numbers came out crazy. I'm going to show you. If I take the percentage of 202 divided by the income statement 214, you get 94%, 92%, 81%. It's not too crazy, but it's dropping significantly. So I don't know how accurate that's going to be. I just took the last year. Okay. Other expense income. This is clearly cyclical, negative, positive, negative. Okay. So I'm going to repeat the cycle. I'm going negative, positive, negative, positive, negative, positive. So I'm going to have 2020 equal to 2018, positive. And when you copy to the right, it goes negative, positive, negative, positive, negative, positive. Okay. So listen, just one thing I want to say, because I got 2 minutes left. I understand this might look a little kind of crude, but this is a projection. And if you disagree and say, well, I'd rather take the projection of the 91%, 91%, 82% and use that 82%, good. You're digging into it in a little more detail. What I would say to that, though, is if you're a little uncertain, highlight this red. Build your model. Get your valuation. Then go back and say, well, what if I used a different method? Would that really change my answer? And I'll tell you, you get 164, or if you do it the other way, I tried it, you get 140 something million. You're talking about $20 million on a business that's making how many billions of dollars, $38 billion in net income. It's not going to change your valuation. You want to focus on the line items that really do change your valuation. So now we've projected as much as we can our operating activities. Next week, we're going to get into projecting CapEx, how to project our investing activities and our financing activities. And then we're going to move on to finally one of the supplementary schedules, the depreciation schedule. Okay. And so just because somebody had asked, I'm going to go through once again the projection techniques. Let me see. I only have Excel up, so let's see. Can I open a new tab here? The projection techniques, here we go, are 1, take the minimum of 3 years, right? 2, maximum of 3 years. 3, average 3 years. 4, take the last year. 5, take a percent growth. We do this with revenue. 6, we're going to repeat the cycle. And 7, it's a percentage of an operating item. This is what I'd always lay out, and I'd say, all right, well, for my cash flow statement, I'm never going to do the maximum, right? Because the maximum, guys, we just might get cut off. It says less than a minute. But this is it. But if we get cut off, I'll see you next week. I'm going to keep talking. I'm not going to do the maximum because the maximum is aggressive. I like conservative models. And for a number that was growing, let's say operating income, we're declining. The average doesn't make sense to me. So I slowly narrow it down. I tried percent growth. It didn't work. It's not cyclical. All right, good. Now I've narrowed it down to 3 possible methods. Let me pick one. And usually you can try all 3 and they all 3